Today we're going to try and unpack, a pretty major paradox playing out in global finance.
It really is. On one hand, you have this incredible explosive optimism around AI.
And on the other, this almost cold dread about sovereign debt and a flight to physical assets.
Exactly. So our mission today is to dig into a stack of analysis from Fund at Mental and find the connection, see how these huge forces are linked.
Sounds good. Let's start with the immediate timeline. The source is called 22 days.
Right, because that's what we have left, 22 trading days in 2025.
And U.S. stocks have had a great year. I mean, the S&P is up, almost 17%, NASDAQ up over 21%, but that's not the whole picture, is it?
Not at all. The really interesting thing happening right now is that non-U.S. markets are actually outperforming. They're trying to close that valuation gap.
And the calendar is just packed with huge events.
Oh, absolutely. You've got the December 10th Fed meeting, of course, but also the Fed chair decision, a major tariff ruling from the Supreme Court.
And potential conclusions to big geopolitical stories, Ukraine, Venezuela. A lot could shift in just a few weeks.
Policy is really going to dictate where we land.
Okay, so let's get to the engine behind so much of this market movement, AI. This is from the source, ChatGPT impact.
We're now 3 years out from that launch, which is hard to believe.
And the Magnificent Seven have returned 300%, a staggering number. But here's the paradox, the real aha moment in this piece.
Despite that huge U.S. tech concentration, both the Italian and German stock markets have actually outperformed the S&P 500 overall.
How does that even happen?
Well, the analysis points to the second and third best performers during this whole AI boom, and they were gold and silver.
Real money.
Exactly. It suggests the world sees AI as the new growth paradigm, but also understands it's the only way to try and inflate away all this accumulated debt. The victory of AI will be so expensive it almost necessitates currency debasement.
Which is a perfect segue to the next source, gold and silver. The numbers here are just wild.
They are. Silver up 90% year to date, gold up 58%.
So beyond general inflation fears, what's the big structural driver here?
It's central banks. Overwhelmingly, they're diversifying and fast. They're worried about U.S. debt levels, for sure, but the real trigger was the freezing of Russian assets.
A huge precedent.
A massive one. If you're China, you're looking at that and accelerating your move into assets that can't be frozen. There are even whispers about physical supply stress, pointing to that CME silver futures incident.
Right, where the official explanation didn't quite add up for a lot of traders.
Let's just say there's a strong belief that there isn't enough physical metal to meet a huge delivery demand.
So that's the physical side. Let's look at the policy side with narrative shift. Inflation is down. The Fed has finished its quantitative tightening.
$2.2 trillion of it, yeah. And now they're getting ready to cut rates next week.
But the part that's raising eyebrows is this idea they might start buying T-bills, which they're very careful to call not QE.
Right, not QE, but it's still injecting liquidity. And you have to ask why. This need for buyers, it's critical. Which brings us to the source on stablecoins.
The timing on this IMF report feels significant. The U.S. government needs a buyer of last resort for all the bonds it has to issue.
And stablecoin issuers are massive holders of treasuries. So the administration is basically clearing the regulatory path for them to grow even faster. They're cultivating a new essential buyer for U.S. debt.
But that all depends on the growth story holding up. The source, who is going to tell us, throw some cold water on that.
It really does. The sheer scale of the capital expenditure is staggering. More data centers are planned for 2025 than in the last 15 years combined.
And the energy demand is 80 gigawatts. That's like adding a whole country's power grid in 1 year.
And it's mostly debt financed. At the same time, the source says corporate AI adoption is starting to flatten out, early adopter saturation.
So you have this growing gap between massive costs and maybe, just maybe, slowing revenue adoption.
It definitely puts the whole AI is economic messiah narrative into question.
Okay, last piece of the puzzle, and it's a big one. Yen and Bitcoin.
This is the global risk factor. Japan is the biggest foreign holder of U.S. treasuries, $1.2 trillion. And they're the most indebted major economy.
And the fascinating link here is that Bitcoin is moving in lockstep with the weak yen.
Which implies a major player is using the yen carry trade. They're borrowing cheaply in yen and pouring that capital into riskier assets, like Bitcoin.
What happens if that unwinds?
That's the ticking time bomb. If the Bank of Japan has to sell its U.S. treasuries to prop up the yen, it could trigger a huge sell-off in Bitcoin and other U.S. assets. It's probably the highest leverage point in finance right now.
Wow. So to sum this all up, we've got a market just roaring ahead on AI enthusiasm,
While at the same time, there's this desperate, fearful flight into hard assets like gold and silver.
all happening under the giant shadow of sovereign debt.
So here's the final thought for you to take away. If the world is truly counting on inflating away its debt, and the performance of gold and silver suggests it is, how fragile is that entire AI growth story? What happens if central banks make a sudden, coordinated shift away from the dollar? That's the huge unknown heading into the new year.